Have you ever sat down after a totally normal week? Nothing special on the calendar, just your usual routine, only to feel your stomach drop when you check the news. Imagine you did everything right. You paid your bills, you saved a little, maybe you even invested in some big tech stock because it felt safe. But then one morning, you see a headline: Microsoft just lost $350 billion. In 6 hours. That's more money than most of us will make in a lifetime. And the weirdest part? It didn't happen because of some disaster like a scandal or a failed product launch. It happened on a day when Microsoft's earnings were okay. On paper, nothing catastrophic at all. You think, that doesn't make sense. And your brain does that thing. Maybe you missed something. Are other people onto something you're not? Are you behind? Here's the part nobody tells. It's not that Microsoft did anything dramatically wrong this quarter. The rules of the game quietly changed. This is Ben's money milestones. For people who feel behind, but aren't done. In other words, what happened to Microsoft just happened to millions of families in their own way. A company can do everything right and still get blindsided by hidden math under the hood. And if a giant like Microsoft can lose a chunk of value that big, it tells us something important. The system's incentives have shifted, and the same quiet math is affecting your budget and your future. We'll break this down together, step by step, in real terms, with names, real numbers, and real feelings, so you can see exactly what's going on. Let's start with the immediate shock. Microsoft's stock plunged about 10% in a few hours, erasing roughly $350 to $360 billion of its market capitalization. To put that in perspective, $350 billion is more than the entire GDP of some small countries, or the annual income of roughly 6 million American households. For most of us, it's beyond comprehension, but it should trigger a gut reaction. It's like watching a skyscraper crumble in minutes. Even more striking, analysts noted this was Microsoft's worst one-day drop since March 2020, when the markets crashed at the start of the pandemic. If you lived through that, you remember the terror. And yet, this time, there was no pandemic. There were no major layoffs or headline disasters. It was a pretty normal quarter. So why the panic? Because the stock market doesn't play by normal logic. It's not just about the raw revenue. It's about growth expectations, costs, and sentiment. Microsoft's cloud business, Azure, grew by 39% year over year, which sounds enormous, and it did beat the consensus. Expectation was 38.8%. But last quarter, Azure grew 40%, and Microsoft has been the fastest growing cloud company for years. For investors, that slowdown from 40 to 39%, just 1 point, was like getting a 3.9% pay raise when you thought you'd get 4%. A raise is still good, but now when inflation and costs are also high, this tiny slip in cloud growth was treated as if everything collapsed. On paper, revenue was up 17% year over year, hitting about $81 billion, which beat estimates. But on paper, it can be misleading. If you compare it to personal finance, imagine running a small business or a household budget. You've doubled your revenue in 1 year, but your bills have tripled. You put extra money into a renovation, or in Microsoft's case, AI infrastructure, and suddenly there's barely any profit left over. You did everything right. You expanded, you invested, you chased growth, but the net effect feels like nothing changed, or even worse. Now look at your balance sheet again, and you have less cushion. That's exactly what shareholders saw here. Microsoft poured money into growth. More on that in a bit. And the bottom line didn't get much bigger, so it was time to freak out. And that panic is contagious. When a stock as big as Microsoft gets hit, mutual funds and algorithms start selling. Picture a retirement fund that owns 2 million Microsoft shares at an average price of $400. That's an $800 million position. If everyone panics and Microsoft's valuation multiples drop, say PE from 30 to 27, that fund just lost $80 million on paper on an earnings beat. Their risk managers trigger sales to protect against further loss, which pushes the price even lower, a domino effect. That's why roughly $500 billion can vanish from the S&P 500 with a single news release. It's like if every bank in your neighborhood suddenly decided your mortgage was 10% riskier at once, even though you made your payments on time. But let's remember who the villain is here. Not you, not the average family, not even Microsoft's workers. It's the system, the incentives, the expectations expectations baked into the math. For years, Microsoft had a first-mover advantage in AI thanks to early ties with OpenAI, the ChatGPT people. They pumped that advantage to become the world's most valuable company by late 2024. But that also set up a trap. Everyone expects jaw-topping growth because they rode the AI hype train early. So when growth isn't jaw-dropping, remember, 39% isn't small in real terms. The narrative flips. We have to see proof of payoff or else. And guess what? Microsoft is spending crazy to deliver that payoff. In the last quarter, Microsoft's capital expenditures, money they spent to build data centers, buy GPUs, expand cloud capacity, jumped 66% from last year to $37.5 billion. That's not a typo. $37.5 billion in one quarter. To relate it, that's like if a family making $100,000 a year suddenly spent $250,000 on a mortgage and renovations in 3 months. The fun part is Microsoft is doing this mostly on AI chips. About 2/3 of that capex went to GPUs and CPUs for their cloud. Meanwhile, they forecast the next quarter of Azure growth to be 37 to 38%, basically flat from here. Why? Because they literally can't build infrastructure fast enough to satisfy demand. That sounds positive, they could sell more, but it means they have hit a ceiling. If you have 100 customers who want your product but only enough raw materials to serve 80, your growth flatlines. For Microsoft, 39% growth might be the max for now, not the floor. This is where it quietly breaks. The inflection point is now for AI. Microsoft CFO Amy Hood even said, "If I had taken the GPUs that just came online and allocated them all to Azure, the growth would have been over 40%. She's basically admitting the dilemma. Use every chip for Azure, the growth engine, or save some for their own first-party AI products like Copilot and Bing Chat, which also promise future revenue. It's like deciding between paying down all your debt or treating yourself to a new laptop with that extra cash. Either way, some people will be unhappy. Investors want high growth now. The company needs to invest in long-term growth. Imagine you're a mid-level manager and your boss gives you $1,000 unexpectedly. You could plow it into next month's mortgage to feel safer, or use it to buy the kids' school supplies early so the next 3 months feel easier. You can't do both fully. Microsoft is in that tough spot with a lot more at stake. That $1,000 was like the difference between 40% and 39% growth. Seemingly small, but in this world, it matters a lot. Meanwhile, if you look at gross margins, profit as a percent of sales, Microsoft's has been creeping down. It's at 68% now, the lowest in years. Why? Because AI infrastructure is expensive. In cloud computing, a typical data center might enjoy 60 to 70% gross margins when selling simple storage or business software. But those fancy AI chips cost tens of thousands each, with lifespans of only months before new models appear. So every dollar of Azure revenue from AI eats more dollars of costs. Think of it like this. If you normally spent $5 to make $10 in revenue, 50% margin, these AI services might cost you $7 or $8 to get that same $10. That margin erosion shows up as slower profit growth, even if revenue's up. It's like you got a raise, but your rent and grocery bill went up even faster. You don't feel richer. Now, let's bring this down to earth with some real families. Meet Sarah. She's 28, single, renting in Columbus, Ohio. She makes $52,000 a year, basically the national median. After taxes, her take-home is about $3,400 a month. Her rent is $1,200. She's lucky to keep it that low. Car payment plus insurance eats another $450. Her student loans tack on $280. Health insurance premiums already come out of her paycheck, but she still has a $3,500 deductible that's not met. She's eating brown bag lunches most days, driving an older car, and living on a budget. By the end of a normal month, no vacations, no emergencies, just life. She's got maybe $100 left. If a single grocery bill hits $200 instead of $150 one week, her budget's tight. If the rent suddenly jumps a little next year, she has to shuffle money again. She did everything right. She didn't go on shopping sprees or skip loan payment, and yet she's barely treading water. Now think, what if her landlords all acted like Wall Street? If Sarah's doing everything exactly as planned and still feels broke, is there something wrong with her, or is it the system? Rising rents, student debt, and healthcare costs, all subtle forces she didn't control. Microsoft's quarter is a similar story. They ticked all the boxes: good revenue, beating estimates, winning accounts, But external costs, AI chips, expectation shifts, made it feel like everything got worse instead of better. Or consider Luis and Maria in suburban Denver. They have one young kid, combined income $95,000, median-ish for their area. Their biggest expense is the mortgage, $1,500 on a $350,000 home in a decent neighborhood. Car payments and insurance are $600. Utilities, internet, phone, groceries, daycare, it all adds up to another $1,700. They contribute to a modest 401k but haven't built a big emergency fund. In a good month, they might save $200. But if the car needs unexpected repair or the baby has an ER visit, those savings vanish overnight. They could feel secure if they had an extra $10,000 in the bank. That's their milestone for now we're breathing room. Most Americans say hitting a few months of expenses saved is life-changing. For Microsoft, a milestone might be something like reaching a point where AI revenue pays for all that AI spending, maybe at, say, a $50 billion quarterly profit. Arbitrary big number. They're not there yet. Instead, Microsoft is effectively treating thousands of hardware dollars as investment now and hoping future revenue will catch up. So investors acted like, if that future isn't here yet, we're nervous. Let's bust a myth here. Tech booms always mean easy games. We grew up hearing stories about people who bought Apple or Microsoft stock and got rich. The myth is that these things only go up, but in truth, behind every high-flying tech company are limits. How much they can build, how much people can afford, how many chips exist. For years, Microsoft's cloud growth looked unstoppable. Just like for families, it looks unstoppable when you first get your degrees and job. But eventually, limits emerge, and when they do, investors suddenly notice. It's as if society made invisible rules. Growing by 40% for decades is normal. Any slower and you're doomed. It's nonsense. Most companies don't grow 40% forever, and if they did, they'd eventually max out. If the only measure is more growth, you end up punishing anything else, like profit margins or long-term stability. Now, there's another piece. OpenAI. Microsoft put big chips on the line with that partnership. They own roughly 27% of OpenAI after the latest restructuring, and they've poured around $13 billion into it since 2019. In return, OpenAI agreed to use Microsoft Azure as its exclusive cloud provider. In theory, this is a goldmine. OpenAI with ChatGPT is a cash cow, and now it sends so much business to Azure that Microsoft's cloud backlog doubled to $625 billion. That backlog is like a giant promise of future revenue, and 45% of those future services are tied to OpenAI. So half of Azure's on-the-books business is one partner. Imagine if you owned a small online business and 45% of your next year's sales came from one company. You'd be uneasy too. If OpenAI stubs a toe, your forecast wings wildly. Investors realize this concentration risk. What if OpenAI stumbles or can't pay or decides to spread its cloud computing to others? After all, that deal did say $250 billion of Azure purchases, but we don't know how that will actually play out. For Microsoft, that's like promising to pay your rent with your best friend's IPO money. It sounds great until that friend hits a rough patch. And yes, OpenAI has its own worries. They had a code red moment in December when Google's new Gemini and Anthropic's new model showed up. Suddenly, this once plucky startup is scrambling to keep up. Microsoft's fortunes are now deeply entangled with OpenAI's success. That's not something Wall Street loves to see. Regulators aren't thrilled either. Both the US FTC and the EU have put Microsoft OpenAI under the microscope for possible antitrust issues. The FTC is literally demanding answers about these cloud AI deals. Why mention this? Because it's another layer. When the win-win partnership could become a legal headache, it adds to investor jitters. So let's tie this back to you. Here's why it matters at your kitchen table. You might not own much Microsoft stock, though many 401ks do indirectly, but you do own a stake in the system it represents. The same market math that punished Microsoft can hurt your finances in subtler ways. Rising interest rates, inflation, tight credit, these are the systemic big tech hangover for Main Street. You feel stuck even when you don't make reckless choices, just like Microsoft's fine growth got punished. The uncomfortable truth is that the world changed quietly. Companies are forced into a tech arms race. Amazon, Google, Meta, Microsoft, and even Rivian or Ford with chips. And none of them can opt out. Collectively, they plan to spend over $500 billion this year on AI. That's an insane number. Even if one of them wins, it might not pay off for a decade. Meanwhile, costs come out of profits and market calm. When the CEO says AI is in early innings, they mean we're spending so much now that you won't see a return for a while. For everyday people, it's a reminder that early innings looks different for everyone. While tech CEOs throw billions at R&D, you might be throwing hundreds at emergency savings. The principle is the same. Do you fund the playground grade or the trip to the dentist first? It's hard to know, and the pressure to pick the right one is real. And don't lose heart. This story has a hidden silver lining. Understanding it takes power. You now see that when the media screams about another stock crash, they often mean the math shifted, not everyone screwed up. Microsoft's latest quarter actually showed better overall revenue and profits than expected. But the narrative turned grim because the spending trail was huge. For a family, it's like knowing that your paychecks actually covered groceries this month, even though you blew your budget on a new couch last week. You might feel shaken by the couch bill, but deep down, paying the bills means you're okay. Likewise, Microsoft's business is still strong. Its total profit grew year over year. We just don't see that in the stock price right now. By keeping the focus on the external factors, AI chip scarcity, investor expectations, deal concentration, we spare ourselves the guilt. The villain isn't discipline or hard work, it's these giant trends. And remember, you are working hard. You see through the hype, you save your pennies, you keep asking questions. You're smart, and maybe slightly too worn out to hope that raising your credit limit solves anything. Guess what? That skepticism is exactly what you need. So what now? You're not going to change overnight the fact that a lot of money is swirling in strange ways at the top of the economy, but you can change how you feel about it. Clarity brings quiet relief. You aren't broken because you can't keep up with these flashes and slides. The system has become more complicated, not your life. Your goals, having an emergency fund, paying down debt, maybe buying a home, don't vanish just because a stock chart dips. The path forward is about understanding that this is the new normal. Big numbers, big swings, and big hidden trade-off. Here's the uncomfortable truth. What you just saw isn't the worst case. It's the average for this AI era. The average tech quarter now means massive spending, and the average market reaction can be brutal. And average is exactly why so many people feel stuck even when they're doing everything right. The markets don't care about your sense of fairness, but once you understand the milestones, the spending thresholds, the capacity limits, the dependencies, you start to see the pattern. The pattern is this train isn't just Microsoft's, it's society's train. Full speed into AI and inflation and thin margins. But here's the thing. Recognizing these milestones means you can spot the next shift sooner. Today it was Azure growth. Tomorrow it could be something like when Microsoft's own AI products finally pay off, or when interest rates stabilize. That next shift is the moment your money stops controlling you and you start controlling it. And guess what? That moment comes sooner than most people think, whether it's in the market or in your personal budget. The puzzle pieces connect. You start to see that inflation, interest rates, your paycheck versus your receipts, it's all part of the same math that just took Microsoft on a wild ride. The math is hard, but it's not impossible. By understanding it, you give yourself the quiet comfort of knowledge. No false hope, no hype, just the relief that comes from knowing the game isn't rigged against you. It's rigged for someone else's incentive. So take a breath. This isn't about you failing, it's about everyone learning the new rules together. And once you know them, you can plan around them. Maybe it means diversifying better, or focusing on budgets that aren't as tied to these tech swings. Maybe it just means mental freedom to say, I'm not falling for the next crazy pitch. Hold on to this. You're not crazy to feel behind or anxious. The giant you trusted also felt a little behind, and it nearly tripped. But just as we learn from their missteps, you can learn to keep steady. That's your true financial freedom, understanding the system enough to navigate its twists without panic.